Mike, welcome to the show. I want to get right into it as equities are showing, as you describe in your notes, some nervousness. At what point does a kind of stoppage of the rally or consolidation or just a brief kind of hiatus from blistering pace of new gains become more interesting? At what point does it become concerning about trend reversal?
Ooh, trend reversal, very good. Boy, I think we need at least a 10% correction from the high before I think anyone can seriously talk about a reversal of the bullish trend. You know, this bullish market's been going like gangbusters since the scare of the pandemic. And, you know, you could argue that we've been in a bull market since '09, and every dip has been bought. And I don't see that behavior changing. Any investor that's been in this game for more than a few years has learned the lesson that all dips are to be bought. So I don't think a small pullback in stock prices is going to change the prevalent attitude on the street.
Mike, the rate situation, is it clear that that's the culprit here for the weakness in your mind, as the rise in yields that we're seeing to explain for that specifically poor performance in the NASDAQ?
I think that's a contributing factor. I think part of this is also just technical. You know, February started like a bat out of hell. We had 6 consecutive up days in February. And here we are looking at maybe our 6th consecutive down day towards the end of February. So, you know, while I'm sure a lot of people are a little bit worried about this downward move and they're trying to point to a fundamental reason, I think a lot of this is just what goes up must come down. Now, the rates component is not to be ignored. I think that people are paying more attention to rates, and we're becoming more sensitive to valuations as a result. You know, rates have made a demonstrably higher move, and we've broken out of some technical levels in the rates world. And so that is a factor in terms of the mindset of the investor population and the market. And so that matters. But I don't think that that is the cause. I think we were ready for a pullback. Rates continued to climb, and so the two things went hand in hand, and we've got, let's call it a run-of-the-mill shaving back of prices. You know, if it turns into a cascade of selling and you get true panic, then the game will change. But right now, to me, it looks like we were due for a pullback. Rates helped push us over the edge, and now here we are correcting a bit.
With that in mind, how do we measure, again, to kind of come back to the question of how do we assess a pause versus some change to the narrative or the overall dynamics that have been bullish, right? The idea has been stimulus and recovery together. Equities can, you know, just climb basically to infinite valuations, right? Nobody's really been concerned about valuations from that perspective. And where the rates argument comes in seems to change that maybe a little bit if we're going to have to think about what we're paying for those future cash flows if rates are going up. But Mike, we're at record high valuations by just about every metric. So when do we become impressed by a sell-off? Do we look at VIX? At what VIX level do we say, hey, this is, you know, powerful here? I mean, we've seen 40 just a couple weeks ago. We saw you know, into the hundreds for moments back in the crisis. So with this kind of setup, what do we look for here as kind of our guideline?
Yeah, I don't know if there's a magic level for the VIX, but let's just say it's got to be above 40. You know, this bull market cannot end out of boredom. It has to end because the perception of all of us changes, and we say these valuations are insane. The world is not as rosy as we thought it was, and we have to collectively get scared. Now, where does that happen? Who the heck knows? But above 40 is certainly where it might happen. It isn't going to happen at 26. So I think for this correction to become more than temporary, we need a sea change in thought, and that requires a lot of fear. And VIX above 40 is part of that. I think you have to be down more than 10% from the highs on the S&P. Maybe the 10-year has to be up near 2%. You know, all of these things are not required, but those would be the conditions that would indicate that the world has changed its mode of thinking. Right now, the world is thinking that the future is rosy, and whether Google's trading at a 30 PE or a 31 PE, who cares? The bull market ends when people start worrying about Google trading at a 20 PE.
Well, I think that's a pretty good characterization of the way sentiment really has to change. You're right, and sometimes there doesn't necessarily have to be some big obvious reason. It's just when the popular view shifts towards one that is of concern. Mike, in terms of volatility and what your team is doing at Harvest, right now investors are looking at, as we're talking about VIX, and they say, well, if I have a bunch of stocks, how do I hedge this? Do I pay up for volatility above historical normals? Do I get bonds, which are going down on stock down days? What's the answer? Can you give us an idea how one can find opportunities to hedge an equity position?
Good question. Boy, that's the magic question. For sophisticated investors, obviously there are collar strategies in the options world that I do not recommend that you attempt that unless you are sophisticated and you understand these instruments, or you have a sophisticated advisor who could help you put that strategy in place. That's a possibility. I only mention it as a possibility. The more practical and I think cost-effective thing to do is to just trim positions. Don't go crazy. This is not an all or none situation, but if you have been long for a while, you have wonderful gains. Realize some of them. Take a 5% equity weighting off the table and just keep it in cash, or a 10% weighting, somewhere in that neighborhood. Small moves to reduce risk is the most cost-effective way to go, and it's simple. And have that cash on the side. Maybe you set a timer. Maybe you say, I'm going to wait 3 to 6 months. And if a buying opportunity happens, I put that money right back to work. And if it doesn't, I miss out on a small amount of upside. So be it. But for the sake of sleeping well and for the sake of having a portfolio that doesn't influence your thinking in the moment, there's nothing better than taking risk off the table the old-fashioned way.